Everybody, hope you're all doing well. My name is Bennett Tchaikovsky, the accounting professor here on YouTube, and today we're going to be going through some financial statement analysis. In particular, we're going to be going ahead and looking at profitability ratios. So my disclaimer and copyright notice, the information and opinions in this presentation are those of myself and not my employers or other affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're going to go ahead and look at different profitability ratios, and we'll kind of, some of this information I borrowed from Investopedia, others are from my AI application, but let's go ahead and just kind of go run these down. So the first one is going to essentially be my gross profit margin. And if we look at a company like Five Below, and again, if I kind of just pull this over here to their most recent quarterly report, when I'm looking at things like their gross profit margin, right? So what exactly is this going to be? It's going to be sales minus cost of goods sold. And what's interesting here is with Five Below, they're not really they're not showing us gross profit. Rather, they're kind of just bleeding everything into operating income. Whereas if you see a company like, and my favorite one is always to do is to look at the Home Depot. If I go ahead and look at the Home Depot and I look at their financial statements, their quarterlies, they're absolutely going to be showing me net sales less cost of goods sold equals gross profit. So you'll see different companies do things different ways, but hopefully by going through and using ratio analysis, we can even it all out. So basically, this is measuring the percentage of revenue that exceeds cost of goods sold. And so here we go. Okay, so for Five Below, and we're going to go ahead and pull up our income statement. Notice I'm not going to use the trailing 12 months for this. Obviously, I could, but I'm not going to. So if I looked at this over here for my gross profit margin, I'm going to go ahead and take my gross profit. Well, I don't know what that is. So I have to figure out what is my gross profit. Well, my gross profit is basically going to be my sales minus my cost of goods sold. That is going to be my gross profit. Okay. So my gross profit right over here is going to be my sales minus my cost of goods sold. For 2/3/24, do the same thing. My sales minus my cost of goods sold, or 1,273,825. I'm dividing this by my sales, 3,876,000, and this is going to be 3,559,000. So when it comes up to here, my gross profit margin is my gross profit divided by my net sales, or roughly this is going to be 34%. Over here, this is going to be about 35%. So if I multiply this by 100, or I'm just showing it in a percentage format, so my gross profit was basically for the year ended February 1st, 2025, was 34.89%. Over here for February 3rd, it was 35.79%. Let's go ahead and take a look at the next one, is the operating profit margin. And this is helping me kind of focus on my profitability from my core business operations. So as we come over here to go through and look at Five Below, we're going to show our operating income. Now, this might be a little bit easier for us because guess what? They give us operating income. So right over here, my operating income is in my numerator, or 323,817. Over here for 2/8/24, 2/3/24, it was 385,571. And then I've got my net sales right over here. And Okay, so my operating profit margin is going to be 323,817. I'm going to show this as a percentage. And there we go, 10.83. So my operating profit margin has gone down year over year. Now, one of the things I want you to notice is that why are we highlighting depreciation and amortization? Well, it's going to make the analyst's life a little bit easier because these are non-cash items. Remember, when we record depreciation, we're debiting depreciation expense, we're crediting accumulated depreciation. On the statement of cash flows, depreciation expense is always going to be an add back, similar to stock compensation expense. Okay, so let's go ahead and go now back to our next ratio. Our next one over here is going to be our net income divided by our net sales, or we call our net margin or our net profit margin. My net income over here was basically 253,611. Over here for my, over here, this is going to be 301,106. And again, I'm dividing this by my net sales. And I'm going to always wonder, if you're taking my class, I want you to go ahead and basically round it to 2 decimal places. So over here, my net margin is going to basically be about 6.54%. And this would be 8.46%. Okay. Let's now go to our pre-tax margin. Okay, so before I get too far ahead of myself, the net margin shows the percentage of revenue that remains after all expenses, taxes, and interest. My pre-tax margin is a profitability ratio that measures how efficiently a company generates earnings before taxes relative to my revenue. It shows what percentage of sales remains as the profit before income taxes are deducted. How's the company basically, what's their cost management and operational efficiency before the impact of taxes, right? We all have to pay taxes because we do not want to end up in federal prison. It's not fun. Okay. I don't know about it, but I've heard it's not fun. Okay. So what I'm going to go ahead and do here is this is going to be my earnings before taxes. So a way I can kind of go through and do this is it's already basically given it to me. It's going to be 338,665. This over here is going to be 401,101. I'm going to go ahead and divide this by the same thing, which is going to be my total revenue. And when it comes to percentages, this is going to be slightly higher at 8.74% and then 11.27%. Okay. Let's go ahead now and take a look at our return on assets. Our return on assets, or ROA, and this is going to be something we're going to be exploring a little bit further when we look at the DuPont formula. So here, when we look at net income, was 253, and over here, this is going to be at 301. For my average total assets, and we're going to now come over here to my balance sheet. And again, let's take a look at what the return on assets measures. The return on assets is a profitability ratio that measures how efficiently are we using our total assets to generate profit. It shows our ability to turn its investments into investments and assets into earnings. A higher ROA indicates a more efficient use of assets. Remember that one ratio by itself is not going to determine our fate. Rather, we have to kind of go through and look at each one individually. Now, what are my average total assets going to be? So I'm going to go ahead and write this down here. My average total assets is going to be my beginning total assets plus my ending total assets. I'm going to divide this result over here by 2. Okay. You don't have to do this on, this is not going to go on our scorecard. I'm just showing you how to go through and do this. And we can do at the same time. You can also say our average shareholders equity. This is going to be our beginning stockholders equity plus our ending stockholders equity. And we're going to divide this result by 2. Okay. So when we look at this over here, our beginning total assets on our balance sheet was at 4,339,574. Our ending total assets on our balance sheet was 3,872,37. So our total assets are going to be for the 2 years, it's going to be 8,211,611. I divide this result by 2. So my average total assets here are going to be 4.1 billion. So my return on assets for basically 2125 for the year is going to be roughly about 6.18%. Coming over here, my average total assets, my ending assets for the beginning of the prior year. I'm going to go ahead and add in basically 3,324,911. I'm going to add up these 2 results here, divide by 2. I'm going to come up over here with 3,598,474. And so I already know that this is going to be higher. Why do I know that? Because my assets are lower and my net income is higher. So I had a higher return on assets by about 8.37%. Okay. Now going down over here to my return on equity, which is going to be my net income minus preferred dividends. Now, note, most of the time, and this becomes the basis for DuPont, it's a profitability ratio that basically measures how efficiently a company uses the money invested by our shareholders to generate profits, and indicates how much net income is earned for each dollar of shareholders' equity, providing insight into a company's financial performance from an investor's perspective. The one thing I'm going to caution you on is if your company that you're looking at has treasury stock, you're going to have to do a little bit more of a deeper dive into the formula. It becomes a lot more complicated, especially for a company like the Home Depot. So, but here we go for our average shareholders equity. So our return on equity, and note over here, we're generally not going to have preferred dividends for publicly traded companies. I always love it how someone will say, oh, Bennett, this one actually have preferred dividends. But it's generally really not going to be that much of the case. So, but when I look at shareholders equity, my average shareholders equity over here was 1,808,327 to begin, 1,584,956. I take these 2 amounts, I'm dividing by 2, and I'm getting 1,696,642. So my return on equity is going to be about 14.95%. Coming over here for the prior year, my beginning becomes my ending, and then I'm adding in over here my equity of 1,361,929. I'm adding up these 2 amounts, dividing by 2, and I'm getting a total of 1,473,442, 443. Okay. And so my return on equity is dropping year over year. Okay. So I've gone through now and have computed these profitability ratios. Are there other ones you can use? Yes, there's countless ratios. We're just doing these for these companies. Of course, they don't have meaning without context, which is why if you're doing one of my projects, you're going to be comparing 2 different companies, but that's why we're doing them in the same industry, so we can essentially see which ones are best for us. So let's go ahead and now add this into my summary, right? So for my profitability right over here, my gross profit margin is going to be 34.89, 35.79. My operating profit margin is going to be 8.35. and 10.83. My net profit margin is going to be 6.54, and then 8.46. My pre-tax margin is going to be 8.74 and 11.27. My return on assets is going to be 6.18. And then over here at 8.37. And then my return on equity is going to be 14.95. And then this is going to be 20.44. Okay, so that goes ahead and takes us through our profitability ratios. So I want to thank you for watching and for being with us here today. I look forward to seeing you on the next video. If you have questions, feel free to email me, 1812cpa@gmail.com. I appreciate you liking and subscribing to the videos. Have a great rest of your day, and I will see you on the next video. Have a great one.